Get into it. All right. Hey, guys. Thanks for joining us today. My name is Eric Wilkinson. Going to do a little webinar here on risk reversal. This is a beginner to intermediate strategy. Now, one thing you're going to have to check out, and one of my regulars told me that you might need tier 3 for these particular strategies. I don't know why you would. Maybe it's only on the downside risk that you would need the tier 3, but just check with your broker to see if you have the clearance to do something like this, and if you don't, then ask for it, because this is a pretty good strategy, especially for the long side. But before we get into that, let me go over a couple of things real quick. This is, like I mentioned, going to be on the risk reversal. There are two types of risk reversals, really. The reason why it gets the name risk reversal is because it is a hedge against your overall portfolio. Now, this risk reversal is a bullish market assumption, but if you were to use it as a hedge, it would really be to hedge a short stock position. I don't suggest ever going out there and doing this short stock position. You could just do a synthetic, and it's a lot better, and we've talked about that in one of the previous webinars here. But it is a hedge, and that's why it's called a risk reversal. It's really to hedge your directional risk. Does that make sense to everybody? So make sure that you know that, or you could just play it as a bullish market assumption. It's going to be less volatile than those synthetic longs and synthetic shorts that we just got through covering. This is a way to take a little bit of that risk off so that you're not getting real violent moves. It'll really smooth it out a little bit. So I'll talk about that here in a little bit too. But let me get these things out of the way real quick. I see you guys are blowing me up on some questions. I'll try and get those after I get through this stuff. But my name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I've traded my own money for over 25 years now, and I'm not going to tell you I'm going to make you rich or make you a millionaire. I'm not going to even tell you exactly what stocks I think you should put on, because that's not my game here, you guys. My thing is to teach you guys how to do these different strategies and when is the most appropriate time to do that. I'm not the guy that's going to go out there and say, hey, Tesla's a buy or Tesla's a sell, that's not how I play. I'm trying to teach you guys how to be self-sufficient, if you will. All right. So I basically started out trading in college with some money I'd earned. I started buying stocks before I really knew any better, and then started using options to cover those. I was doing covered calls. And then later on, when I moved to Board of Trade, I expanded into all different kinds of options, playing around with puts and all those fun options. But in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products, basically in all market conditions. So I've traded through a lot of that. As a matter of fact, when it's crazy like it's been for the last couple of weeks, I think that's the best time to start trading. We used to say on the floor, when there's blood in the water, it's time to go fishing. All right. So a couple of people at the beginning of this webinar were saying they had the best weeks they've ever had. And a lot of that has to do with taking advantage of volatility. All right. Anyway, any opinions, news, research, and analysis or other information contained here or other material provided by Pro Trader Strategies and associated companies or employees is provided as general commentary and does not constitute investment advice or solicitation to buy or sell any of this stuff we're talking about, you guys. And at the end of the day, please remember that past performance of any trading system or methodology is not necessarily indicative of future results. The beginning of this, it says, any opinions, news isn't a solicitation to buy or sell any of these things. The reason why is because I don't know your risk parameters. I don't know what's in your portfolio. So therefore, there's no way that I can actually tell you guys something is appropriate for you. You're going to have to take what we teach you here and implement it into your portfolios when it is appropriate for you and in your own way. All right. One other thing is you can follow me on Twitter at Wolfman's blog, and you can follow our company at Pro Trader Strat. All right. I mentioned this is going to be the bullish risk reversal. I think it should be called the contrarian trade, really, because the way that we're going to be setting this up is the best way to set up A risk reversal is when you are a contrarian to what the broader market is thinking, believe it or not. And it has to do with the premiums that we're going to be playing around with. And I'll get into further detail as we go along here also. But just keep in mind, I mean, the best time to put this on is when your assumption is opposite of the skew in the market. And I'll talk about that. So that's where I come up with the contrarian trade. Anytime there's skew in the market, it means, you know, the equal distance calls and puts aren't priced the same. Meaning if something's trading 100, the 110 calls are trading at a different price than the 90 calls. You know, they're equal distance apart, but they're different premiums, and it has to do with whether people are bullish or bearish, because that's what, when they're buying options, they pump up that premium. All right, so let me go over a couple of these real quick. I see a couple of questions I want to bang out real quick. So live workshop confirmation. Yeah, this is a weekly live workshop confirmation out. So they may send out 2 videos. One is what the actual webinar is going to be on, and the other one is basically that's what this is. That's what I do on Fridays, is an option live workshop. All right. Thanks, Eric. I want to right. Yeah, Ted, just reach out to me. I'll talk to you. We'll square things away. I can't really do that right now. Here's another options for intermediate long risk reversal from Eric. Yeah, there's 2 different ones for the same thing. Sorry. Can we see an example in Walmart or Roku? Yeah, Eric, you know, once we get through these slides, which let me bang these out, and then I will throw it out to everybody to get it to me. So when I give the word, remind me, and I'll check those out for sure. All right. Couple of things to know about is this is a neutral to bullish assumption. Now, it says neutral. We really do want to be bullish. At the end of the day, we do not want this to go down, and you would never put this on in a bearish assumption. The reason why it can be neutral is because we're going to be offsetting a lot of the different Greeks, if you will. So that allows it to be neutral, because we're not going to be risking a whole lot if it stays right where we're at. But we definitely, to bring home the bacon, we want this to be a bullish market, or at least have a bullish move. Not necessarily a bullish market, because it could be a bearish market trend in the underlying that you're looking at, and you might think it's overdone, which would be the contrarian, right? And looking for that market to move higher. Would be the scenario we're looking for this, because people are afraid when the market comes off and you have that correction, and those puts will get pumped up, which will ultimately help us out. So basically, we're going to be buying an out of the money call and selling an out of the money put. Now, when I set this up, you guys, I put it up here so you're buying the call, because that gives you the directional, makes it a little bit easier for newer people to understand. When you're buying a call, that's a bullish move, right? Same thing when you're selling a put, that's also bullish. So it's a bullish call and a bullish put in a sense. But what I do is I set it up by selling this out of the money put first. And the reason why I do that is to see how much money I can spend, because ultimately we're going to get a credit for this, and that credit we're going to get for this is going to pay for our out of the money call. And if this put pays for that out of the money call, that allows it to be this neutral assumption, because if the call or the put pays for that call, then we kind of have a credit or didn't pay anything. So if it doesn't go anywhere, it doesn't hurt us. If you do it for a debit, though, you need to really have that move higher. But I always try and do it for at least a credit, or I'll play around. You can play around with the strikes to get that credit, or I'll move along with a different strategy. All right. So here's a couple examples. This Twitter example, I can guarantee you is old, but when I was setting these up, they worked out pretty good as examples. As you can see, I'm trying to pick them when they're as close to the full dollar amount to make it a little bit easier to understand the equal distance is what I was talking about. So in this regard, I'm going in there, and I usually like to start out with like the 25 delta. option. That to me gives you the best bang for your buck and the highest probability of success, because we're trying to get a directional move, and you know, a 25 delta is about as good as you're going to get. If you get really close where you're doing a 50 delta here and a 50 delta here, well, that's just basically the synthetic long, and we've already covered that. The synthetic long is going to be more volatile. It's dollar for dollar move with this underlying. Now, if we do this one with a bullish risk reversal, then we're going to be able to see this market kind of fluctuate between our call and our put, and we'll be okay. Ultimately, we want it to go up and test our long calls. And you can play it beyond that. I usually, when it goes to that long call, that's usually where I'm looking to get out of that move. And it will, the reason why is I've beaten the probabilities. And if I've beaten the probabilities on a relatively low probability strategy, then I'm going to walk away with that money. I'm not going to let it ride out. So, for instance, this one's trading at 18. If we look at the 17 or the 16 puts in this example, and then buying the 20 puts, selling the 16 puts and buying the 20 calls. Sorry about that. You can see we're doing this for a debit. Now, I don't like to do it for a debit. Even though those are equal distance away from each other, what's happening here is because I'm not able to pay for this call with these puts, it means there's skew, because we can say that, you know, 1795 is really close to 18. So in that regard, these puts are closer to where it's trading, but these calls are more expensive, you know, because we've got, what is that, $3 to the upside. Wait, 17, 18, $2.05 to the upside and $1.95 to the downside, right? So one would expect, these being closer, that they would be able to pay for these calls. But obviously there is a very bullish assumption in Twitter during the time that I took this screenshot, because it turns out as a debit. You know, we want these puts to be able to pay for these calls. Does that make sense? The call delta is higher, and that has to do with this. So Farshid was saying, well, the delta over here on these 20s is higher than the delta on these puts, and that's why you're going to have that premium discrepancy, right? Well, that is true, but this delta also is a product of these premiums. And what happens is we can figure out skew by looking, if we take the 18 and go equal distance away, which is very difficult to do, go equal distance, $2 down, $2 up, these premiums should be the same. They're very close. Don't get me wrong, but they should be the same in, you know, a perfect world. If there was no skew, if it was that perfect bell curve I've shown you guys so many times on different webinars. What happens is basically somebody's gone up to a perfect bell curve and just leaned it over just a little bit, one direction or another. This one is leaning towards the call side, which means there's a lot of bullish assumption around Twitter during this time. Another example would be, I didn't skip over too many, did I? Another example would be in applied materials, AMAT. It's trading very close to 45, which would be this one at the money, right? I mean, we're off by a couple of pennies. If we go equal distance down, going 3 down and 3 up, so from 45 to 48 and from 45 to 42, I mean, we're off by a couple of pennies here. We would be able to do this strategy for even, okay? So that is showing us when you go equal distance up and equal distance down and it comes out for 0, that means there's no skew, okay? And despite the fact that the deltas are a little bit off, you know, a little bit of that delta being off, it has to do with this 9-cent increase over 45, all right? That's fine. That doesn't make up for a lot of the other discrepancies there, right? These puts. So there's basically, I mean, very little skew, I could say. There's a little bit of skew, but very little skew. And then we go at an example of this one. Now this is Verizon, and this has skew to the call side. Now it looks a little funky, I know. You know, these are all single digits going down for the most part. And then once we get above 50, they start going into $2.50 increments, okay? So it looks like this is very close to at the money. Like, whoa, those puts are paying for the at the money. It's not the at the monies. As you can see up here, we're trading at $50.06 in the underlying. So this is really the at the money. But if we go $3 down, we're able to get, you know, let's call it 66, 67 cents, just going mid-market here for $3 down. But then you go $2 up, $2.50 up, and we're able, or they're only, you know, 53 cents. So you can see that these puts are further distance away from where the underlying is, and the premiums are bigger. Okay, very close in deltas, but you can see the pricing is way off by 10 cents, right? Even more so, you could say, because these are 50 cents closer, which is a perfect scenario for a bullish risk reversal. To be able to sell these puts, which is really where our risk is, you guys, right? Because these are our puts that we are naked short in a sense. We're really not naked short, but in a sense we are, because you know these calls aren't covering it. So it is very close to being naked short puts. So we don't want it to go down here, but I'm still able to collect a credit, which is good. So that means the skew is to the put side, and we're going to be able to do this strategy just about on any underlying after the last couple of weeks we've had, you guys, because everybody and their brother was buying puts during that time, which really has inflated these puts over here, and they haven't really come. You know, we've seen volatility come out a lot, but the puts are still holding some of that volatility in there. And even though we're seeing volatility come out, it's still the highest volatility a lot of these stocks have seen in like 2-3 years. So it's still high implied volatility in and around these underlyings. So this kind of skew is what we're talking about. People are worried about the downside in Verizon. So that's where the contrarian in this is. People are concerned about the downside, and we're like, hey, you know what? I'm not worried about the downside in this. I'm going to go to the bullish side, and this would be a great scenario to set this up because you're getting a credit. The puts are further away from where the underlying is trading, which is really where your risk is, and then the calls are very close. Now, one thing I want to go back and mention about picking the right strikes on this. That's really what this has to do with when we're picking the right strikes in an underlying. When I go through my keys to success, that is an example of picking the right strikes. Being able to have the puts further away than where our calls are. We wouldn't really want to have to, you know, sell a put that's closer than where we're buying that call, because that, you know, then our risk is closer to where the underlying is trading, and I'd rather have it be further away. Does that make sense to everybody? Tried to explain that in 2 different ways to make sure you guys got it all. All right. But how do we make money with this strategy? Or is it just for hedging? We can make money on this, Noel. It is for hedging, and that's where the name came from, risk reversal. It was a floor term, and it had to do with, you know, if I'm short this, I need to do a risk reversal. And the risk reversal really was, you know, to protect you if I was short something, to protect me to the upside if it rallied, if I was short the underlying, let's say, and I was starting to worry about the upside. Well, this would be a good one because it gives me a lot of wiggle room inside there if it starts, you know, going the direction I don't really want it. And then you would cover that strategy when it made that little move and still leave on your short if you wanted. Right, okay. Did I answer your question there, Noel? All right. All right. So let me go through a couple of things real quick. So keys to success, picking the right underlying. This has to go with, if you guys look at these right here, picking the right underlying, this is 63 days out. Now, my rule is to look at like the ones that are inside of 35 days to expiration for this rule, but Verizon is very popular amongst options traders. So you can see picking the right underlying means that a stock that's under $100, we want this bid to ask right here to be less than the ones that are close to at the money, to be less than 10 cents wide. And we went through that high implied volatility or the big vol move not too long ago. And these probably were 10, 15 cents wide during that really high implied volatility. And that's why we want to start out trading with these strategies when there's tight bid ask, or know which ones generally have tight bid ask. Because when the market gets crazy, volatility expands, that means risk has gone up. And when risk goes up, you guys, these people that are making, and you included, making these markets aren't willing to give up as much edge and want to make wider markets to ensure that you get a good fill in a sense. And when there's panic, those things are going to move out. So when they start out like this and these move out, that's better. Then if you got into this trade in low implied volatility and the bid to the ask was like 30 cents wide on a $50 stock, what happened when that volatility expanded? Those went to basically $1 wide. I mean, they exploded. Nobody was willing to take risk in those. All right. So that you really need to start out when the bid asks are pretty tight. So my rule of thumb here is a stock under $100, 10 cents wide from bid to ask. All right. About 35 days to expiration. This one's further out, but still meets that. And I can guarantee you these 35 days to expiration are going to meet that too. All right. The other thing is, if it's over $100 stock, let me try and find one with the real platform. If it's over $100 stock, okay, Deer, I have this left over from an earnings trade that I did. So Deer, it's $100 stock. So we go to the 28 days, $100 stock. Basically, on this one, we're going to move the decimal 3 ticks to the left. Anything over $100, just move it 3 ticks to the left. That's how wide the bid ask should be. So it should be about 17 cents wide from the bid to the ask. And these are pretty wide. Deer generally will have pretty good markets, but that's what we're looking for, is something that would have 17 cents wide to the bid ask, and that's when we're going to trade it. It has still pretty high implied volatility, but it says 40 IV%, but if we look at the chart, I bet it's very close to 100 historically, right? Like normally it would be up here, so that'd be about 90 something. So they're a little bit wide because they just had earnings. But that's the rule. What we're looking for is move it 3 ticks to the left over $100 stock. $1,000 stock like Priceline, we'd need it to be about $1.80, maybe $2 wide on something like that. Okay. Somewhat need to try it. What do you, I guess I need, to try it as a hedging strategy or just as a trading strategy, Noel? All right. Next thing. So that's picking the right underlying. First thing we do is we need to make sure that we have tight bid asks on these. So picking the right underlying. Picking the right strikes. This goes back to what I was talking about, making sure that you use those puts to pay for those calls, and that the puts are further away than the calls are to the underlying. Okay. We want those puts to be further away. That's our risk. We want that risk to be further away to increase our probabilities of success there. All right. Picking the right duration. Now, the beautiful thing with this is, you could do this risk reversal, in the weeklies, with 10, 15 days to go. But the beauty in this strategy is we're going to offset a lot of the grease. If you remember me mentioning that earlier, we're going to be able to offset pretty much all of the delta, or not, sorry, we're not going to be able to offset delta. We are going to offset the volatility, and we're going to be able to offset the theta decay. So if we can offset, think this through, you guys, if you can offset theta, which is the thief in the night that comes and steals your premiums, if there is no thief, if you can isolate that, what's your duration? Well, our duration can be further out, because further out in time. So we want to go a little bit further out in time. I talk about this with about, 70 plus days or more to get there, because we don't have to worry about the theta decay component, and we don't have to worry about volatility necessarily. So if we don't have to worry about theta, let's stick with that right now. We don't have to worry about our duration. So if we don't have to worry about our duration, let's go further out in time. It may make us move out, one tick or something like that. But at the end of the day, we have a lot more time to be right. So time is our friend in this instance. This strategy, we are predicting an upward move. So Noel, scratch out the against. In this strategy, we are predicting an upward move. We are bullish in this. And the reason why it's called a risk reversal is because, what we were looking at is, we're short a stock, or we're short this underlying, or, it could be a future or something like that. And that's how we used to do it on the floors. We'd be short futures. We would see the market go against us immediately, throw on a risk reversal to protect us a little bit to the upside if it makes that move. And if it does make that move, we see it happen and then cover it, when we are profitable on the risk reversal, and then ride out the bearish outright that we had on. Does that make sense? All right. So it is a little bit confusing. I should just call it the contrarian trade, because the way I set it up, you're pretty much a contrarian to the market, which is good as far as I'm concerned. I like it when it's like that. All right, picking the right environment. Now, a lot of times with these environments, I talk about, high implied volatility, low implied volatility. What strategy do we put on around this? You can do this in just about any implied volatility environment. Any volatile, it can be low implied volatility, can be high implied volatility, because we're offsetting those. But to keep in mind, because you don't have to worry about that, doesn't necessarily mean it's the right strategy for that situation. Yes, this has a bigger payout than, let's say, going out and selling calls or selling puts in a high implied volatility environment, but our probabilities of success are so much greater with those. If I have high implied volatility and I'm bullish, I am probably not going to use this strategy. I'm probably going to lean towards selling puts, which I've done. I've done webinars on those and talked about those. I'm not going to really go into that, but since that is a higher probability strategy, I would default to that. So the times I like to use this bullish risk reversal is really when I have low to medium implied volatility. So, somewhere in the 30s to 50s, maybe 60s, somewhere where I'm kind of like, all right, well, I don't want to buy calls in this situation because implied volatility is in and around 50. It could go up, it could go down. It could go either way. I don't want to sell puts for this, sell puts for the same reason. I'm directionally bullish, but it's right there in the middle. If volatility expands after I sold those puts, that's going to hurt me, and things of that nature. So we're isolating that. Not really sure where volatility is going to go, and we've isolated it. So if we've isolated it, though, and we're right around that mid implied volatility percent, that would be the time for this one. Does that make sense to everybody? Really high implied volatility, I can neutralize volatility with this strategy. But is there a higher probability strategy that fits my directional assumption that has a higher probability? Well, yes, selling puts in that situation would be a higher probability strategy. It's not going to pay out as much, but I'm the guy that likes to go for singles and doubles, you guys, not home runs. And that's another reason why I said as soon as this underlying goes up and touches my long calls, I'm probably going to get out because I've beaten the probabilities. And something I'll mention here anyway while I'm talking about it. It's a floor trader hack that we used to use to determine probabilities. And one of the things on the probabilities, let's look at delta. Delta tells you so many things. I mean, delta tells you like 6 different things. I'm only going to mention one of them right now. Now, delta, the definition of delta is it tells you how much this premium is going to change for the first dollar move. All right, well, what does that mean? For the first dollar move up in DEER, going from where it's currently at 169 to 170, 169.44 to 170.44, this premium will increase by 33 cents on that first dollar move. All right. Delta also tells you the probability that this strike, the 175 strike, will be in the money at expiration. It's a 33% probability DEER will be trading at 175 in the next 28 days. Okay. It also tells you, if the market goes from 169.44 to 168.44, this premium will decrease by that amount on the first dollar move. Second dollar move gets a little bit fuzzy. Second dollar move up, so it goes to 171.44. Gamma adds in there. So that second dollar move, first dollar move, this goes up by 33 cents. Second dollar move up, it goes up by 36 cents. Okay. But delta, more importantly, right now, what I wanted to get at, delta tells us our probability of touch or being tested. That's what we used to say on the floor is that, what's my probability of being tested on this? What, this underlying coming up? Well, it's 2 times the delta. So delta is a 33% probability of being 1 penny in the money at expiration. So DEER trading 175.01 in 28 days at expiration. There's a 33% probability of that. But in the meantime, in the next 28 days, it's 2 times the delta. So there's a 66% probability in the next 28 days that DEER is going to trade up to 175. Not necessarily putting it into the money, but coming up and boom, hit 175 handle here. Okay, so it's a floor trader hack. It's not like perfect math or anything like that, you guys. I can't pull you up Black-Scholes and necessarily prove this, but as floor trader experience, that was our rule of thumb. And rule of thumbs are generally a little bit light. So a 66% probability is probably closer really to 70 or more. But that was our rule of thumb. We'd rather be safe than sorry, right? So 2 times the delta is your probability of being in the or of the underlying coming up and testing that strike. Now, this one that's in the money, well, it's 120 or 130% probability, right? Because it's 2 times. Came up and touched it. So we're in. All right. Does that make sense? So that's why when I'm buying a 25 delta call and the underlying, there's only a 25% probability of me being right at expiration, but there's a 50% probability of me being right at least during the duration of the underlying I'm trading. So that probability is better, right? If that probability is better, that's why I'm taking it off then. Does that make sense to everybody? I see a bunch of questions are coming up, so let me try and backtrack a little bit here and get back to a couple of them. Is this strategy we are protecting against an upward move? Yes. Protecting against it or capitalizing on it. Noel, you can put this on. If you're bullish in DEER, you have no underlying, you've never traded this, you could put this on DEER for a bullish trade. Okay. The longer the duration, the shakier all of those probabilities get, right? No, I would say I would respectfully disagree. I'd say the probabilities are the probabilities. All right. One thing is, though, the further out we go, this 175 delta is probably going to be a little bit lower when we get further out. Actually, it's for higher, a lot higher. So that's even better too, right? Yeah, we'll go through this, and we'll try and get through the nuances of this real quick. So let me get a little bit. I'm getting a little bit behind. So it'll all come together when we pull this all up. And knowing your exit strategy before entering the trade. What did I say mine was? I don't know what you guys want to come up with for yours, but when I'm doing this strategy, I look at it like as soon as my short call is, or my long call is touched, that's when I'm normally going to get out of it. But you can also use this with, your charts. If you're looking at this and, I guess I'd have to do Fibonacci extensions if I have that on here. Let's see what I got. Is this, I don't think this is the extensions. I think this is extensions. All right, so let me see if I can get this done right. So let's just go like this for the bullish move. That's not what I wanted. I want to go like this, sorry. So for this bullish, I'm just going to go for this bullish move right here, and it's going to be dirty because that's about the high, and then kind of, why aren't you working for me? All right. Anyway, so you can use your Fibonacci's, I guess is what I'm coming up with. You can use your Fibonacci's, you can use whatever you use and say, when the underlying goes up to this certain point, that's where I'm going to get out. I don't know where I have the Fibonacci's lined up for a particular strategy, but let's just see how it works on this one. All right. Why aren't you going to doing something wrong here? So for instance, if you wanted to play around with this for the Fibonacci's, it came up here, it settled down. I don't know. It gets up to the 50 fib. Maybe that's where your out is, and that could be a little bit higher than where that long call is, but you can coincide that. What I want to emphasize here, you guys, is when you know your strategy, when you're setting this up, right? I hope you guys aren't just willy-nilly doing this. Like, you know what, I'm bullish on this. I have no idea where I'm going to get out. I'm just going to play it by ear. I would like to be a little bit more concrete than that, because when if you just throw that out in your head and it gets to that point where you're like, oh, well, I'm going to let it go a little further. I'm going to let it run, and try and squeeze a little bit more out of that. Well, that's usually when this comes back to haunt you, because the probabilities, like I said, are the probabilities. So if you've beaten the probabilities, get out for one. And if it's gone to your assumption and that's what got you into this trade, get out. Don't squeeze it, and write it down on a piece of paper. I have spiral notebooks stacked up so high right next to me to my left that it drives my wife nuts, because I just have, she's like, do you need all those spiral notebooks out there? Well, I write down every single trade. I write down the date, every trade I put on, why I put it on, what the market conditions were, and what led me to that assumption. And then I write down what my exit strategy is, because if I write it down, I'm more likely, and so are you, we are more likely to follow through with our exit strategy if we write it down. And that has to do with going back to staying mechanical, you guys. The best way to get ahead in this game is being mechanical. Like, don't overthink it. I'm giving you guys rules to follow. I don't know what everybody's risk parameter is on an exit strategy, so I can't really tell you, hey, this is where you should get out. I can tell you what I do, and I will look at what the probabilities are on the strategy. If it goes up there and hits that, I'm going to pull the ripcord on it. I don't care if I don't make an extra $2 or $3. I'm not even going to go back and look for the next probably 5 or 6 days after I got out of that trade and met my assumption. Because if I do go back and look and I realize I was wrong, well, then it's going to change my thinking. And I will almost assure you that the times that you guys try and squeeze it out for an extra couple of pennies and are wrong and end up losing some of that is going to happen more often than those times where you covered it at the price and you look back at a day or two later and it's like 10 ticks higher. Okay. That's not, just forget about that. Just don't even go back and look. Play the probabilities, because they will ultimately end up working out in your favor. All right. All right, maximum profit is infinite. I'm not going to take it that far. I'm going to go to the probabilities. My probability of max profit being infinite is slim and none, and slim just left town. So not going to happen. So pick your spike spot that you want to get out of. Your maximum loss is going to feel unlimited because it can go to zero. What's the likelihood? Slim and none, and slim probably just left town too. But it can go to zero, and it can double, triple. So we're not writing those out, or at least I'm not going to write it out that far. I'm going to know where my exit is also on this, and that's basically if it goes down and touches my puts, I know the probabilities are probably beating me there too, so I'm going to look to get out. Or if it breaks below a Fibonacci level or one of my other support resistances that I've come up with. All right, why is it so important to get those credits on this strategy? One is because if you do it when you're receiving a credit, your break even is way down there by your put strike price minus the credit. But if you do it for a debit, your break even is up there by that call strike. That's at expiration, okay, you guys? This is at expiration. It's not going to feel like that during life of the strategy while you're trading. This all has to do with at expiration. But this is the importance of getting a credit. Would you rather have, in that one example that I showed you guys of deer when we had this up, let's see if I still have it up. Actually, I think it was the Verizon one I did it on. That's SPY. Let's look at Verizon. Let's look at, I don't have it up, but remember on that one, when we had bought these and sold the 2.5s for, a 1 cent credit, would you rather have your break even down here on a bullish assumption or your break even here on a bullish assumption? We want it up here, right? We want it down here, right? We do not want it up here. We'd rather have all this room to be wrong. So that's why it's important to do it for zero or at least a credit. All right? Because that is going to determine where your break even is. Is there a long risk reversal on the SPY or the NASDAQ? Yes, we could do that on the SPX as well, for sure. Plan your trade, trade your plan. HH, you threw that out another time, and I should have wrote it down. And I didn't. I wanted to use that a couple times. I'm stealing that. But yes, that is so very true. All right. So this is the time where I was talking to Eric. I think you wanted Walmart. So I'll start off with that. He was the early guy. But this is where you guys throw it out there. I'll go over a couple of examples, and we'll see if it fits with these rules. All right. So one of our rules of thumb, we look at the 28 days to expiration, picking the right underlying. We want our bid ask to be 10 cents wide, which this got a little wide, but Walmart is 10 cents wide usually. After the market on Friday, holiday weekend, nobody's leaving anything in there over the weekend, so they're going to get a little wide. But you can see Walmart is going to usually be within 10 cents wide. I can assure you on that. So let's just assume that it's fitting the rules. So we can go out, play around with both of these 63 days to, 120 days. I usually default a little bit inside of that, but we'll see. We'll play it out both ways. So I usually go to the puts, look for that 25 delta put. All right, this would be the one I'm going to be buying. Buying. So this is the one we're going to be buying here. $2.46 is how much I can spend. What? No, I'm sorry. $2.46 is what I'm going to spend on these, be able to spend. So I'm selling those. Sorry. $2.25, $2.30 or something is what I'm going to be able to spend on these. So that puts me right about here at the 115. So these are the ones that I'm going to want to buy. And you can see I'm getting a credit there for it. And I don't know why there's a negative there. You can easily tell that if I sell these, that's a higher price than where I'm buying these. So I'm obviously getting a nice credit for it. We have the delta is very similar. As a matter of fact, one of the things I do like to do is add these up to be about a 50 delta, and that usually works out pretty good that way. So now let's just see where the skew is. We're trading at, let's call it 105, right? Can we round up 25 cents? So these 105 strikes are pretty much the ones that are at the money, and my calls are $10 higher, and my puts are $10 lower. And as you can see, we got a little bit of credit for that. So one could say there is skew to the put side because we're equal distance away. We're still getting our credit. That means these puts have a little bit of skew in it. And it could basically be, one could account, it's 78 cents. We're 25 cents lower and closer to this, but that's not going to make up for that much credit. There is a little bit of a skew. What do you think about TIVA? Thank you. Yeah, good question. Yeah, I mean, Berkshire, I heard Buffett just got in TIVA, but I don't trade it very much. Is this going out 110 days? It is, Farshid. We're out 120 days. I probably wouldn't keep it on for that entire time. I'm only looking for it to come up here and test these. So the 115s is where I'm going to go here. Well, is that too far away, $10? Well, let's just look. If we're getting a little bit nervous about that, we can go in here and get a little bit tighter. The closer to the expiration you're going to get a little bit tighter. And if you get a little bit, you're going to be able to get a little bit of tighter on the strikes for the most part, but you're also decreasing your probability because you have less days in a sense. I mean, your probabilities are the probabilities, but I'd rather have a little bit more room. And this is a little funky because they got the half strikes, so I'm pretty much going to have to go with, I could squeeze it in a little bit, I suppose. So we're going to sell those, and then I got $2 and something to spend and buy these. It's a little bit higher deltas than normal, but you can see we're $5 to the upside, $5 to the downside, still got a bit of a credit, which is good. That means our break even's down there below that 100 strikes. So, and I only have $5 to get to the upside. Does that make sense for you guys? All right, I saw a couple other people were throwing out a couple of them. I think it was, SPX was one of them. Yeah, you can totally do this on SPX. If you're trading SPX, you want to have an account, a margin account or something like that, the account you're trading in, to be about 100,000 or more. And the reason why is because of the weighting of this. You don't want to do you wouldn't want to do a 10 lot of SPX in a $100,000 account. You'd want to do a 1 lot. The other thing is if you're in a $100,000 account and you're using SPY, you should seriously consider moving up to SPX and doing a tenth of the size. So in that regard, if you were doing SPY 10 lots, go to SPX and do 1 lots so that you save on commissions. They're going to act exactly the same at that ratio. Because you're doing a tenth the size on the SPX. You just move the decimal place. So keep that in mind when you're playing around with SPX, SPY, you guys. All right. Yes, and Farshid, SPX and SPY have different tax treatments as well. I actually don't. I'm not a tax accountant, so don't take my word for it. Or I'm not an accountant, so I can't really speak to that. You'd have to ask your attorney or your CPA. All right, so I like to usually go to the 25 strikes, so it's down here, 26.10s, $2. And so what's our rule? You move the decimal place on a big stock, 3 ticks to the left, $2.70. Are these $2.70 wide? Yes, they're less than $2 wide. So that fits the rule. 25 delta is what I'm looking for here. This is the one I'm going to sell. And then go look for that $31 I can spend on something. So I can, look at that. I can get way down here and spend my money very nicely. So there we go. So the underlying is trading at 27.32. let's call it, it's 27.32.5, so it's right in between these two. So what we can do, since it's right in between these two, we can actually start with the 30s here just to make math easy. And we could say to the 27.30s all the way down to the 26.10s. 27.30 to 26.10 is 120, right? So 120 points to the downside. And then if we just take out the 35s and add in 120 points to the upside, that would give us 28.55. And we're well inside of that by about 50 points. So obviously the skew, especially with this, usually there's more skew to the put side as people are putting on protection. So this risk reversal, bullish risk reversal, is much easier to do than the bearish risk reversal, to be quite honest. All right, so a lot of people have protection on this. So you can tell the skew to the puts, we have a lot more room to the downside and a lot higher probability to the upside to meet our objective, because it's a 50% probability we're going to get tested on our downside, right? Because it's 25 delta, and to the upside, we have a 66% probability of meeting our objective to the upside. And we're getting a fat credit, which is nice. So if the underlying traded in between here in the next 60 some days and just bounced around, blah, 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 went sideways, we'd get to keep this credit too. Because if it's trading inside of our strikes, what happens? The calls expire worthless, the puts expire worthless, we get to keep our credit. Needs the cash covered. So yeah, if you're having issues with like margin in your let's say or in an IRA, especially because they hate you on margin, you know, one thing to meet that rule is just to go out and spend that dollar on a put, and it's really not going to decrease your margin too much, but you know, it might help a little bit. Okay. All right. One of the other ones, I vetted the Verizon one for the webinar and used it. So let me try and find another one. I think I have a pretty good one for this one. So this was Philip Morris. You know, if you're bullish Philip Morris, I'm not saying I'm necessarily bullish Philip Morris, but when I did this, it was trading very close to 105 at the time. So at 105 when I betted it, basically went down to like the 25 delta. There's no 25 delta. I got that crazy little half strike there. So I'm just going to go out here and do the 22 delta, sell those. I've got about $1.60 something to spend. I can go out here and buy these for that. Got a nice little credit for it. Did set that up right? Okay, so it's trading 105. I've got $10 to the upside and $10 to the downside for the most part. So that one will set up pretty good. And I got a nice little credit. Does that make sense? That one came off a little bit since I did those betting for that. It was another one that was trading right around the strike. Does anybody else have any other questions, or I got time for maybe one more example if I missed one of your guys' throwing those out of there. That's the idea. We want to be further away on the puts and have those puts still pay for our calls. That's probably the example we had was probably the SPX. All right, so Nvidia is another one Sal just threw out, and this was one I looked at because believe it or not, I'm bearish Nvidia because you guys have all heard about blockchain, right? And you guys have all heard about blockchain and all these these mining guys. I don't know if you guys know this or not, but Nvidia is doing awesome with blockchain. I don't know if there's probably a bigger proponent of blockchain than Nvidia, because each one of these guys that's like setting up a mining operation, they need about, I think they need about, like I heard, about maybe 10 to 15 of these Nvidia video cards to run a profitable mining operation. So that's like, that's like thousands of dollars for one machine. So these guys that are going out there and mining are just buying up Nvidia video cards. Well, one thing is this goes to the cloud, which is really where this is heading. The blockchain, that's going to hurt Nvidia. So I'm bearish Nvidia for that reason. I don't want to change your thought on this, Saul, but a lot of people are bullish on this, and I'll show you exactly how bullish they are, because this is a great one. I actually tried to vet this one earlier today, I believe. So let's go with what, it's kind of a pick 'em between these two. I usually try and go a little bit further out with the puts because that's where my risk is. So I'm selling the 23 delta, and I've got about, let's call it $6 to spend. So I can spend my $6. Best way to spend my $6 is right here at the 275s. So 275s on the upside. The underlying is trading at 244. If we call it 245 just for math purposes, 245 to 275, we got 30 to the upside. And then from 245 to the downside, if we look at it, we're only getting off, $23. So their skew here is to the upside, right? Because the puts are closer than where the calls are. Yeah, I know about the dollar or something, but you guys can see that, that dollar doesn't really make a whole lot, is not going to make a huge difference in me moving out $10 more, right? Is it $10.45 to 20 is 25, and 25 to 75, or sorry, 45 to 75 is 30. So yeah, $5, sorry. And the electricity, yeah, as a matter of fact, HH, the electricity isn't even, if you think about it, and I think if you have like 10 to 15 of those video cards just to get profitable, think about it. And I think once you get over that a little bit, then you start making about $100 a day or something. So really, you're going to have to do it for like a year before you're even at a break even, not including electricity. And I just read an article. Iceland is going broke and running out of electricity because everybody picked them for the mining operations. All right. So that's the biggest takeaway, is make sure if the skew is this way, that's why you're a contrarian, right? Everybody here is bullish Nvidia because of all these video card buying frenzy going on. But the gravy train is going to end if everybody on blockchain starts moving to the cloud. That's going to hurt Nvidia. But what was I going to say? So just make sure your puts are further away than your calls, and you still get a credit. I can't emphasize that enough. I know I've said it 1,000 times, but just make sure if you're setting this up, that's how you set it up. But know that when you're doing that, you're playing a contrarian trade. That's part of your risk as well. All right, guys, so this is the offer, that we're going to be doing right now. A lot of you guys were asking for how you can get the daily market commentaries. Those are where I basically do, I always said I wasn't going to go over 10 minutes, but, I can't stop talking. Just like in these webinars, I go over almost every week. But I think that there's a lot of information that I want you guys to know in those webinars. So I hope you guys are taking a lot away from those. But in those webinars, I pull up and I go through all of the economic data. I go through what that economic data implications are to the economy, how that relates to the economy, which ones are the good ones to look at. And, like crude oil inventories, everybody looks at crude oil inventories. I dig down into those different economic releases and tell you what's really important to look at in those, because the headline number isn't always the number to look at. Even like unemployment numbers, that's not always the number you really need to be looking at. And I go through all of those in these daily market commentaries. And I talk about all my earnings trades and every single trade I do for that matter. So if I'm putting on a trade and it's a loser, you guys are going to hear about it. I'm not going to be that guy. I'm not the guy that goes out there and cherry picks. Well, if you guys did the bullish risk reversal in Nvidia last month, then you guys would have been profitable by, 285%. No, that's not me. I'm going to tell you, hey, I'm bullish on Nvidia and I'm bullish on Nvidia and that's why I'm doing it. And if it goes against me, you're going to hear about it. I'm going to tell you when I get out of it. Same thing for all of my strategies, why I'm putting them on. This is why I'm putting it on. If I was going short Nvidia, it would have been because of that theory I have. So I talk about all that stuff. And with this 2-for-1, it's a great deal. You get all kinds of stuff with this, you guys, not even listed here. You get the daily market commentary videos. You also get access to all the online videos, the live workshops. Also, what's not mentioned here is you get access to me. You get, if you have a question on any strategy or anything that you're doing, if you just want to hear my take on a stock, write to me. You can reach out to me. I have a open door policy. You can just reach out via email or you can call me, or actually reach out to email. If I can't answer you in an email, I will get your phone number and we'll hash it out ASAP. I have a no inbox policy in my email, meaning I answer everybody's email that is looking for an answer, and as soon as I can. And if I can't answer it in an email, I will reach out to you through the phone. All right. So you get access to that. I mean, this is a huge deal. This is a great deal, you guys. So take advantage of that. The link is in the chat window. Sorry, you guys. We've been going back and forth on the questions box. If you do hit that little arrow by the chat, you can see there's a link to this in the window there. You can just click on it. It'll take you straight to this page. Might look slightly different. I think this is yellow now. But and if you're watching this on tape delay, just hit the pause button and type that into your URL. At the end of the day, in all of these videos, all of these workshops, all of these videos you're going to have access to, my daily market commentaries, I talk about probabilities of success and how to increase those probabilities of success. And when those probabilities have gone against us, how to stay mechanical and fight through this trade to turn it into a profitable trade. So if you guys have enjoyed my webinar at all, especially if you guys are one of my regulars, you guys should click on that video there or click on that link there in the chat window to get all of these videos, because this is a lot of information that basically you just go in. There's so much information in there. We made it really easy. There's a little box. You just check it off so you know you've watched it. And you don't have to go back to it. But the bottom line is, you guys, the best way to become a better trader is to constantly learn. And you guys obviously have done that by watching this video. You guys are trying to learn. But, I know a lot of you guys have been out there looking at different strategies. And I know you guys can go online and find the risk reversal online. But nobody's going to explain it the way I do and associate those probabilities and what type of environment, most importantly, you do all these different strategies in. I have specific rules for that. This one isn't so specific because it's the risk reversal. We've isolated it. But, the beauty in this is it's right, or the best place for me, I think, is right around that 30 to 50 IV% for an underlying. So you guys, appreciate your time. But when you guys are using the right tools in the right situation, you guys are going to be more productive state of mind, which was going to allow you to put on more strategies. And when you put on more strategies, it creates more opportunities, right? If you have a lot of different opportunities out there, you're increasing your probabilities of success. And ultimately, you're going to increase your confidence, and it's going to allow you to do more and more and more, okay? And if this strategy goes against you the first time, just know that the probabilities beat you on this. It doesn't mean that it's always going to beat you. Just always stay mechanical. It's the probabilities, and you will be a much happier trader and be able to sleep better at night. I can assure you that too. But anyway, we're offering this trial for you guys today, so I suggest you guys go ahead, click on that link in the chat window, and get on with it. Get on with your bad self. All right. So that's about it. That's all I got for you guys. Appreciate it, Farshid. Thank you guys all for the kind words. I see all you guys are blowing me up right now. I appreciate it. One last thing. I just want to thank you guys all. And remember, in later webinars, we're going to be drilling down on option components, how I trade options, and when and where I find trades that are appropriate, at least for me. You're going to have to decide whether or not it's for you. Also, here's another link. It's not one of those hot links where you can kind of just click on it. You'll just have to pause again. Just want to thank you guys all for watching. And if you have any questions, you can contact me at 310-598-6677 or email us at trading@protraderstrategies.com. But if you guys take advantage of this, which I highly suggest you do, also take advantage of reaching out to me if you guys have any questions. I know a lot of you guys already do that are my regulars, and a lot of you guys have come away with a lot of benefit from those as well. So that's a huge add-on that you don't normally get with any of our other offers. So that's a good one for you guys. All right, thank you. I appreciate it, you guys. Have a great extended weekend. And if you can't take that, take it easy. Appreciate it, Ted. I appreciate the kind words. You have a tremendous weekend too. Take care, everybody. Don't forget to click on that link in the chat window. Later.